Hello, everyone, and good morning. A very warm welcome to BMCC's webinar on navigating Malaysia's transfer pricing updates, developed in collaboration with PwC. My name is Chad, content creator for the BMCC, and I will be your MC for today. Last year, on 29 May, the Inland Revenue Board of Malaysia, or IRBM, released the Income Tax Transfer Pricing Rules 2023, which introduced a series of amendments to improve transparency in transfer pricing. Our speaker, Ong Ai Ling, is a director in the transfer pricing team from PricewaterhouseCoopers Taxation Services. She has more than 16 years of experience in transfer pricing, having been actively involved in numerous assignments for both multinationals and Malaysian groups of companies. Ms. Ong, over to you.
Thank you for the introductions. Good morning. Hope everyone is keeping well. It's good to see so many of you here today, joining us to understand what's new in the area of transfer pricing. Now, before I get started, I would like to just draw your attention to a button on screen, which is the Q&A button. Feel free to send your questions through as I go through the presentation today. I have left ample time at the end of the session to take any questions you might have in terms of the areas I'll cover today. So as you may be aware, there has been many developments over the last 15 years when it comes to transfer pricing in the Malaysian context. It all started with the issuance of the Malaysian TP rules and guidelines in 2012, which brought about the TP documentation requirements. So this was quickly followed by an uptick in audit activity by the Malaysian Inland Revenue Board, the MIRB for short, as they carried out significant enforcement activities to ensure that taxpayers are adhering to these new requirements, having the appropriate documentation in place, and being able to justify the arm's length nature of their TP position. Now, along the way, in the last 15 years, what we have also seen is significant tightening of the compliance requirements here. So this took the form of additional disclosures in your tax returns. So for those who are familiar with the tax returns, you will have seen that you had to make certain declarations and further information to be furnished regarding your related party transactions. Now today, I'll be speaking to you on two specific areas. So firstly, this will be more to do with the recent updates in terms of transfer pricing in Malaysia. This, of course, stems from the issuance of the Malaysian TP rules in 2023. I will take you through what are the highlights here, what are the additional measures that you should be aware of, and more importantly, share with you how this would impact your planning when it comes to your TP documentation, particularly the timing around the TP documents. Now, secondly, alongside that, there has been, of course, a continuous activity by the IRB in terms of audit. I think it's good to share with yourselves what's happened post-COVID. How does that look like today? What is the audit process like? Which are the teams that are carrying out the audits? Has the audit process changed significantly given we are in the post-COVID era and environment today? And more interestingly, what are the common issues coming out that we see, and what are perhaps the mitigating factors you can consider when addressing these potential issues? So you would observe based on the session today and what I share with you, it is key to be well prepared, both from a compliance standpoint when it comes to your TP documentation, as well as being well placed to address any audit inquiry. It is important that your TP is able to withstand the audit scrutiny today. So having the necessary policy, the documentation, as well as supporting information in place is extremely important for you to manage your TP risk. Now, before I delve into the various developments and updates, I think it's good for us to just take a step back to ensure that everyone's on the same page when it comes to your understanding of TP and the arm's length concept as well. Firstly, what is TP all about? How does the IRB interpret this? And I think more importantly, what is it that they expect from you, the taxpayer. So what is TP? In a nutshell, this refers to the pricing of any transactions between related parties. Now, I emphasize on the term any because I feel that there's a misconception out there. And I do get this comment sometimes. When I look at my TP, I just need to be concerned with my pricing of my goods or products, right? So I think this is an incorrect assumption. TP is not just about your goods or products, but it touches on your services as well. So this runs the full spectrum of the various related party transactions. So this could be services such as your management services, your payment for IP in the form of royalty, and also your intercompany financing. So if you have any intercompany balances, payments in terms of interest payments, and so forth, all these areas fall under the purview of transfer pricing. Now, because of the special relationship between the related parties, there is, of course, an assumption that the pricing between the related parties is also special. So it's extremely important to dispel this notion and ensure that you are able to explain that your related party transactions and your transfer prices are appropriate and are no different from the pricing of the same products or services if you had these transactions with unrelated parties. Therefore, this is where the concept of the arm's length price comes in. So that would mean that you are able to ensure that you can explain the pricing of your transactions with your related party is no different and is conducted on an arm's length basis, and it is conducted as if you would conduct it with a third party. Now, another misconception out there is that when it comes to TP, I just need to worry about my cross-border transactions. Again, this is not correct. In terms of the TP rules, the guidelines, and the various provisions, as well as documentation requirements, this applies to both your domestic transactions as well as your cross-border transactions. Now, bear in mind, not every single entity in the Malaysian context would be in an equal tax-paying position. Therefore, it's extremely important for you to be able to demonstrate the arm's length nature of your transactions on an individual entity basis. Now, I think at the end of the day, all tax authorities in every jurisdiction, what they are trying to ensure is that taxpayers pay their fair share of tax. In essence, the requirements to demonstrate the arm's length condition is also an anti-avoidance mechanism. Now, let me just take you through a quick example, an illustration of what I have explained here. So in this example I have on screen, the red boxes would represent related entities, and the yellow boxes would represent third parties. So in terms of the red boxes on screen, you'll be able to see that now. The red boxes on screen, these are your related parties. So in terms of the transactions between these related parties, these will all be your related party transactions, and they will be subject to transfer pricing. So you can see on screen, in terms of the example I have here, not just product pricing, we are talking about management fees as well as royalty transactions. So this is regardless of whether you are fully owned subsidiary or otherwise, you are all considered related parties for the red box entities. Now for the yellow box entities, there's also commission payments and service fees. Now these transactions will not be subject to transfer pricing because these are third-party transactions. In itself, they are already considered arm's length for transfer pricing purposes. Right. Now let me just take you through one other concept, which is around the arm's length principle. Now, if you look at the left of your screen here, this is the definition as taken from the OECD Model Tax Convention. It reads, where conditions are made or imposed between related enterprises, it must not differ from those that were made between independent enterprises engaging in similar transactions under similar circumstances. So quite a few criteria to meet here. For you to compare the pricing of your related party versus your independent party transaction, you must ensure that they are similar transactions operating under similar circumstances. So this could mean geographic conditions, this could mean the timing of your transactions. So there is quite a few criteria here to fulfill, but this is actually the broad definition of the arm's length principle. Now, why do I refer to the OECD? Now, firstly, Malaysia is not an OECD member country. However, when it comes to TP, we do take guidance from the OECD. In fact, if you look at our Malaysian TP rules and guidelines, they do follow the principles espoused in the OECD transfer pricing guidelines. So in fact, the methodology and the way we look at the arm's length principle and so forth would follow the OECD TP guidelines. So in the same way, you would see that this definition on the left-hand side features in the Malaysian TP rules and guidelines in terms of the definition of the arm's length principle. Now, for the MIRB, this is consistent with the objective of avoiding double taxation. At the end of the day, the arm's length principle is the condition that they expect taxpayers must demonstrate when it comes to their related party transactions. So if you look at the rules, the guidelines, and all the documentation requirements, which I will get into a bit of detail on, all these deals with fulfilling this objective, demonstrating that on an annual basis, the TP that you have been conducting is on an arm's length basis. Okay, so now let me just take you through a little bit of background and context in the Malaysian environment before we address the new updates and changes. So in terms of TP requirements here, I have mentioned that we have had a set of rules and guidelines in place since 2012. So that means that it's 15 years in which we have had some form of rules and guidelines in place. So in that time, when the rules were issued in 2012, in fact, it had a retrospective effect to 2009. So TP is not new in the Malaysian environment, right? So alongside that, bear in mind, the Malaysian Inland Revenue Board, or the IRB, has been conducting a lot of audits in this space. They have been auditing taxpayers on TP matters for at least the last 15 years. And they have been very experienced in this area, and they are very well versed with the kind of issues they observe coming from taxpayers as well. Okay, so let me just take you through what is the baseline requirement when it comes to the rules and guidelines. If you undertake related party transactions, you must have in place TP documentation. Okay? When would you need to have this in place? The rules refers to the concept of contemporaneous. This would mean when you are starting to contemplate a transaction, or by the very latest, at the time when you are due to file your tax returns, you must have in place TP documentation as well. This, in the context of Malaysia, would mean 7 months after your financial year end. There's an extension of 1 month for e-filing, so that's electronic filing. So if, for example, if a company has a financial year end of 31st December, typically the filing deadline or the due date of the tax returns would be July, with an extension to August for electronic filing. So in terms of the contemporaneous requirements, it means that on an annual basis, you must also have your TP documentation in place by 31st August if you are a 31st December year-end company. Now, what's changed? The contemporaneous requirement is still there. The documentation requirements are still there. However, what's changed is that the TP rules for 2012 have been superseded by the TP rules of 2023. Now, let me just make this quite clear here. TP rules 2023 will have an effect from the year of assessment 2023 going forward. So all the new measures, which I would share with you next, in terms of the specific additional requirements, will only affect companies from year of assessment 2023 going forward. If you are looking at your TP position before 2023, the TP Rules 2012 still applies. And why this might be the case is that the statute of limitations when it comes to TP in Malaysia is 7 years. So you may not just be looking at your 2023 position, you may be looking at preceding years as well. For preceding years, TP Rules 2012, the requirements, etc., will still apply. Okay. Now, as for the Malaysian guidelines, a common question we get asked also, there has been an update to the TP Rules 23. Which set of guidelines do we refer to? So the Malaysian TP Guidelines 2012 still apply. There were some updates and changes to the guidelines in 2021. We understand that the Inland Revenue Board is also working on a new set of guidelines, and this will be issued in due course. However, if you are looking at your current position, we are looking at TP Rules 2023 plus the Malaysian Guidelines 2012. Now, let me just take you through a few items in terms of the documentation requirements first. Now, to be clear, this is something that does not change, even with the updates to the TP Rules 23. In terms of your TP documentation, this is something you prepare, you maintain, and you keep. You do not submit it with your tax returns. There is no necessity to do so. There is no requirement to submit any TP documents unless you get a request from the tax office. So if that happens, the IRB may send you a request for your TP documents. This will only happen during an audit, whether it's a desk audit or field audit. As part of their request, they will ask for your TP documents. Now, in terms of the TP documentation, it used to be a 30-day timeline for you to submit this. This was revised in 2021. It is now a 14-day timeline, and it is extremely important that you are able to ensure you meet this 14 days timeline. Because alongside the change to the deadlines, there has been an introduction of penalties for late submission in 2021. So failure to submit your TPD would result in a financial penalty of 20,000 to 100,000 per year or an imprisonment of 6 months. So let me just focus on the financial penalties. So for example, in any audit, the IRB would request for your TP documentation for a period of time. It is unusual for them to ask for single-year documentation. So they will ask for your documentation for a period of either 3 to 5 years. Now, if you are unable to furnish it within the 14 days timeline, they can impose a penalty of up to 100,000 for every year. So if you're 3 years, you are looking at up to a penalty of 300,000 ringgit. If it's up to 5 years, you are looking at a penalty of up to 500,000 ringgits. And that is just for failing to submit the documentation within the 14 days. This is before any proper audit is conducted where the IRB will look at your TP position, whether it's arm's length and so forth. This is just a submission penalty. So a common question I get asked on this is, what if I get an extension of time? What would that mean? Because the documentation requirements from the IRB is quite onerous. There's quite a lot of documents which I need to submit to the IRB. I would say all well and good. You can decide to ask for an extension of time, and the IRB officer may grant it to you as well. However, as part of their official response to you, they will also state very clearly that if you are unable to submit your TP documentation on time, the fines and the penalties that I've mentioned earlier on would still apply. So I would say as a strategy, priority is for you to submit your TP documents first within the 14 days. Everything else that in terms of documentation or information that the IRB officer has asked for can be submitted at a later date following your extension of time that you have been given. So that is important for you to take note of. So as I've mentioned, the new TP Rules 23 were gazetted on 29th May 2023 And I emphasize again, this would impact your TP documentation from the year of assessment 2023 going forward. So let me run through now and explain the key changes and perhaps some things you need to look out for and consider as you are planning and preparing your TP documentation. Now, if you recall, firstly, I've explained the concept of contemporaneous earlier. Having your documentation in place before the due date of the tax returns. Now, the new additional requirement is that you must now also date your transfer pricing document. And this date must be prior to the due date of your tax returns as well. So now, if you look back at my 31st December example, it means that in addition to having your TP documentation ready, you must now also include a date to demonstrate that it was ready before 31st August. So this is a significant development. So in the past, we've always had some flexibility when it comes to your TP documents. So in practice, how the IRB will take that your documentation is contemporaneous is so long as you can meet their 14-day timeline in terms of submission, they will then take it in practice that your documentation has been carried out and maintained on a contemporaneous basis. Now, with this new measure, it means that the MIRB would check two things: the date of your documentation, as well as the submission date for you to meet the contemporaneous requirements. So again, you must plan ahead and be prepared to have your TP documentation in place. It must be finalized and dated before your tax returns due date, so there is no longer the flexibility with this need to date the document, right? Another new development is the change to the definition and the calculation of the arm's length range. Now, the arm's length range is extremely important. This is how you, as a taxpayer, is able to justify that your TP position is arm's length. So you need to ensure that whatever position you've taken, it falls within the arm's length range of results, right? But in practice, the global practice when it comes to the arm's length range is a range of results of 25% to 75%. And this is largely what's been followed by Malaysia to date. However, with the issuance of the TP Rules 23, this range is now narrowed. So you need to consider in the Malaysian context that now the range is defined as 37.5% to 62.5%. And your position is only considered arm's length if you fit within this narrowed range. And the TP rules goes on to further clarify that if you fall outside this range, the Director General of the Inland Revenue is able to adjust your position to the median of the arm's length range. So it is extremely important that you make this assessment to ensure that you are also falling within the new set of results and the new calculation in terms of the arm's length range. Significant implications again for the taxpayers. As the arm's length range is narrowed, you need to aim for this narrowed range. This is extremely important. And if you look at it from a multinational's perspective, as a group, you may have some targeted margins in mind, and that might be based on a broader arm's length range of results that you have looked at globally. Now, in the Malaysian context, you need to ensure that whatever targeted margins that you have fitted into a wider range also fits into this new recalculated range of results so that you are in compliance with the local requirements in Malaysia here. So now let me just take you through another significant development is in terms of the additional information, particularly about the group, that now features and must be included in your local TP documents. Now, we have broken this down on the screen in front of you into two categories: group information, which is under Schedule 1 of the TP Rules 23, business information, which is under Schedule 2 of the TP Rules 23. Now, firstly, group information. So firstly, for you to fall within the criteria of a multinational enterprise, that is only when the group information will apply to you. So let me just take you through that first. So this means for you to be a multinational enterprise, the group has presence beyond the Malaysian shores. So if a group just has domestic operations and presence in Malaysia only, this group information requirement would not apply. Okay? For a multinational enterprise definition to be fulfilled, you must have presence outside Malaysia. Second exception, even if, let's say, as a group, you have presence outside Malaysia, but if you look at the threshold requirements, which I will go through on another slide with you later, if you only fulfill the criteria of a limited scope documentation, again, this group information criteria would not apply. So we are looking at two exceptions here. Firstly, you only are obliged to prepare limited scope documentation. Secondly, as a multinational group, you only have domestic operations. So you only have Malaysian operations, you have no operations outside Malaysia. That means for these two categories, you do not need to prepare group information as part of your local TP document. For all other taxpayers, and this would impact most multinationals as well as Malaysian groups with overseas operations, you now need to provide all the group information listed here in your local TP document. And as you can see from this list here, it's quite extensive. This ranges from your organizational structure to your IP information and financing arrangements. There needs to be disclosure about your financial and tax positions as well. So I think from a practical standpoint, it is quite challenging. So look at it this way, you are no longer the only source of information, particularly if you are a subsidiary of a multinational. It is not just local Malaysian entity information you need to furnish in your TPD. You now need to also provide group information, something you may not be privy to, and you must now see and assess within your headquarters or your group tax team where this information could come from. Now, in our experience, a good starting point from your group or headquarters would be if there was a document called the master file prepared globally. Now, within the group, there are, of course, certain country by country reporting requirements. If your group has group revenue of 750 million euros and above, your group is actually obliged to prepare a document called the master file. From our experience, quite a lot of information about the group can be gleaned from this master file. We need to ensure, of course, that it's relevant for the Malaysian entity. So this information would be a good starting point for you to obtain group information. Again, it is important for you to also ensure there's consistency in terms of the information you disclose in your local TP document versus your master file. The IRB can ask for your master file if the need arises. So another practical challenge in terms of the source of information, we note that master file requirements are actually only required 12 months after a financial year end. However, as you can appreciate, your TP document needs to be prepared in 7 to 8 months after your financial year end. So you will encounter a timing issue in this instance. So a decision point needs to make around this. What's a practical compromise? Would you look at prior year master file and have that information in your current local documentation? Do you exclude this and prepare and include an appendix to this at a later stage? So you need to decide as you're planning your TP documentation, how you would approach this, because it is also important in terms of having a consistent approach in terms of your TP documentation and its contents as well. So let me just take you through the second bracket, which is the business information under Schedule 2 in the TP Rules 23. Now, this is largely similar to the list in the Malaysian TP Guidelines 2012. However, now that it's been added into the TP rules itself, it's been given additional weight. I think gone are the days where perhaps you can rely on a somewhat limited deck to represent your TP documents. It is now very clearly stated, and this is the expectation of the IRB. You do have all this information listed here, also present within your TP documentation. Not only that, if you do decide to leave off or exclude certain information, you need to explicitly explain why, and you need to check off these items as not applicable for your local TP document. So as you can see from what I've shared on this slide with you, there are significant additional documentation requirements to the contents of your local TP document. It has become increasingly important to be well prepared. Planning in advance is key because not only do you need all this information, they may not just be with you. You might have to go to multiple sources to obtain the documents. And over and above that, you need to bear in mind there is a date requirement as well. So there's additional pressure for you to have your TP documentation in place timely. Now, a couple of other additional measures, which I'll share with you on screen here. These are two to note. So in terms of the TP rules, it refers to the concept of the most current information available. Now, in terms of assessing an arm's length position, by and large, a significant portion of demonstrating the arm's length position uses what we call external benchmarking studies. So in that respect, we are looking at carrying out an external Malaysian benchmarking study, and that will be then used to justify that your TP position is arm's length. Now, there's usually a data lag in terms of data availability, a time lag in terms of data ability. So for example, currently we are in 2024 today. The most current data we could possibly get might be for 2022 when it comes to benchmarking data. You might get a few companies with 2023 data, available. However, if you were to do and carry out a meaningful calculation and ensure that you are able to calculate what we call the arm's length range, more likely than not, the latest, most current data you are able to obtain will be for financial year 2022. Now, since the rules require us to use most current data, you may need to use 2022 benchmarking data to compare against your 2023 results. Is that an appropriate measure? Do you use this? Is there a practical mismatch here? So something for you to ponder. Do you then adopt a weighted average approach? Is this something more accurate if you do so? You need to consider what will be your strategy. Do you use a weighted average results? Do you use a 2022 data results, knowing full well the economic conditions will be quite different for the 2 years? So that is something to ponder. And that is something that you need to, again, make a decision on as you are preparing your TP documents today. Now, on the transfer pricing methods, this part I would say is a welcome change. So there is no longer this hierarchy of methods. So if you look at your TP documents in 2022 and prior, there is actually a need to go through the 5 transfer pricing methods, explain in the context of your related party transaction why they may not be applicable or relevant, and then only then select the most appropriate method and the profit level indicator. Now, according to the rules and guidelines, the TP Rules 23, what you can now do is just focus on explaining why you've chosen a particular method or why this is considered the best method, explain why you've chosen a particular profit level indicator, and this helps to focus the analysis on the method itself and on the profit level indicator. So this, in terms of the economic analysis, it makes it a little bit easier. I would say definitely a welcome change because it takes away all the other unnecessary analysis and you focus on the evaluation of the best method. So what I've covered here in the last 3 slides are the main changes or the new measures that have been introduced in the Malaysian TP Rules 23. So as you can appreciate, there is significant additional information. Over and above that, you must also consider that there is a deadline, so planning in advance is key. Now, I have one more slide because I would like to touch on the thresholds itself as well. I've mentioned that a couple of times. In terms of the thresholds itself, firstly, if you do not have any form of related party transactions, even if you're part of a group, there is no obligation for you to prepare TP document. So that's quite clear. Now, what form of TP documentation do I need to prepare? So then there are 2 categories that you need to consider. Do I fall under the limited scope category or do I fall under the full scope category? So two things you need to look at. Firstly, the gross income for your entity. Does that exceed 25 million ringgit? The cumulative related party transactions for your entity. So let me emphasize, it's cumulative. You do not look at individual related party transactions. 15 million is the number you need to look at. If you fall below 25 million in terms of revenue and cumulative related party transactions are below 15 million, you can opt to prepare what we call a limited scope documentation. So again, to be clear, if you fall under this limited scope documentation category, you are not obliged to include group information in your TP document. If you fall above this, you are obliged to prepare full scope documentation and the group information under Schedule 1 of the TP Rules 23 would apply. You need to do this evaluation on a year-on-year basis so that you can also prepare the right level of documents. Of course, if you are more accustomed to preparing full scope documentation for your company, and there is an instance where perhaps it will now meet the limited scope documentation option instead. So do you then decide to prepare limited scope or full scope? So there is no obligation that you must only prepare limited scope documentation. You can choose. If you're more accustomed to it to prepare the full scope, then you can by all means do so. There is no restriction in this respect. Now, in terms of the thresholds that I speak of, this is contained within the Malaysian TP Guidelines 2012. This has been taken from that, and the assessment is done on this basis. So this concludes my session on TP documentation and changes or updates to the Malaysian TP rules. And I would say that you can see how the new set of TP Rules 23 would impact you in terms of your approach to TP documentation. There are so many other additional requirements today. So you need to ensure that you are approaching the documentation for financial year 2023 appropriately. You've done the necessary preparation, and you have also made the decision about certain aspects of the documentation, such as looking at your benchmarking set, recalculating your arm's length range, and so forth. So let me take a pause at this juncture. You may have a number of questions. So please do send in your questions, and then we can switch gears and look at the audit environment as well. So now, in respect of the audit environment, as a starting point, let me turn your attention to the IRB organizational chart. And specifically, I've outlined here the teams who are generally carrying out audits. These are the teams that are covering transfer pricing or have a transfer pricing focus. So what you have on screen here is the IRB organizational chart as of 28 February this year. So firstly, let me draw your attention to the box circled in red. So this is the multinational tax branch within the IRB. This is the main team focusing on looking at transfer pricing matters within the IRB. Currently headed by a very experienced officer, Puan Hamisa Ismail. This team is centrally based in Bangi, but they carry out audits all over the country. So TP is their primary focus. However, they would also, in my experience, cover off all other corporate tax matters as part of their audit. So this team is very well resourced. They are very experienced and technically savvy when it comes to TP matters. Their cases veer towards multinational groups with a focus on cross-border related party transactions. So they tend to focus more on these groups. And we have, and across all industries, I might add. So they cover a broad spectrum of industries other than what is covered by the special industry group. So I have circled two other teams in yellow. This is the large taxpayers branch and the special industry branch within the IRB. Now for the special industry branch headed by Puan Rosnita, they would actually cover specific industries. So their specific focus is actually on the financial services sector. So that means they cover banks and insurance companies, as well as the oil and gas sector. So in our experience, companies within the whole value chain of the oil and gas sector, they will all also be subjected to audit by the special industry branch. And then we have one more, which I've circled, which is the large taxpayers unit. This is headed by Encik Kamarudin. So generally, they focus on audits of Malaysian groups. So we are talking about mainly domestic related party transactions. So they largely cover generally all corporate tax matters, but they also focus on transfer pricing matters as well. So I think these are the three main groups. Of course, sometimes you do hear that, certain district branches or state branches, they also ask for your TP documentation. Perhaps not such a large focus by these teams when it comes to TP, but if your audit is being picked up by the M&C branch, large taxpayers unit, or the special industry branch, they will definitely look at your transfer pricing arrangements. They will want to understand your position that you have taken. They will definitely ask for your TP documents and will evaluate carefully the positions that you have taken within the TP document. Now, I think in a way to see which team is carrying out your audit, should your case be picked up, you can actually look towards the audit letter that's been received. In the sign-off by the IRB officer, you will clearly see which department has picked up your case. This will also help to give you an indication what will be the key areas of focus during an audit. Now, let me turn your attention to the audit process. This has changed a little bit with COVID, and let me take you through what the changes are as well. Okay. Firstly, just to be clear, for TP audit cases, the statute of limitation when it comes to TP is actually 7 years. For corporate tax matters, it is 5 years. So TP audits tend to happen in two modes. It's either a field audit or a desk audit. So essentially with a field audit, the IRB officer would actually visit the taxpayer's premises, while with a desk audit, all of it would actually be done via correspondence. There will be no actual visit. If there are any meetings, this will be held at the IRB's premises. Now, in our experience with the M&C branch, if it's a new case, they would actually carry out a field audit first. So that means a new case to the M&C branch. First, they'll carry out a field audit. Once the case has gone through one round of field audit and it's been concluded, for subsequent audits in the future, the desk audit team would then pick this up, and then they will look at specific issues within the desk audit team itself. So as I'm taking you through the various boxes in the diagram in front of you, I will be talking more in the context of the multinational branch, because this is the team with the main focus on transfer pricing matters. Now, firstly, to be clear, case selection is done independently of the audit team. So generally, for the cases to be assigned to the M&C branch, there's an assessment that the taxpayer has carrying out significant related party transactions, and it has transactions with related parties outside Malaysia. So you may ask the question, where does this information come from? So when you look at your tax returns, and for those who are familiar with your tax returns, such information can be readily gleaned from the related party disclosures within your tax returns. So the IRB will do their own data analytics. They will select the cases to be passed on to the M&C branch based on the level of related party transactions. So that means it clearly indicates the main focus of the audit will be on your transfer pricing matters. Of course, like I mentioned before, the IRB may pick up on other matters, other corporate tax matters, including what incentives you have undertaken, what incentives you enjoy, perhaps some withholding tax issues, etc., as part of the corporate tax audit. But their main focus, when their priority, will be on your transfer pricing matters. Okay. Now, all audits was commenced with a preliminary request for information, and there will be a notification letter. So this information is quite extensive. So the typical information that we request for may also include your company's audited accounts, the tax computations, and all your supporting documents, financial information such as your GL, your chart of accounts, and so forth. Now, in addition to this, they will request for the company's TP documentation. And the supporting documents that they may ask for includes your intercompany agreements, your organizational chart, and so forth. Now, let me emphasize again, the 14-day timeline is extremely important. You must submit your TP documentation within this timeline. If you do not do so, the late submission penalties would apply. It is imperative that you do so. Everything else, if you need an extension of time, this is something that you must request in advance with the officer in charge of the case. This is then followed by a formal request and a formal reply granting you the extension of time. Okay? So let us continue with the process on the right-hand side of your screen. So once the initial set of documents is submitted to the IRB officer, they will review the documents, they will have a look at your submissions, and then after discussions internally, they will set a date for the audit with the taxpayer. This will be followed by a confirmation letter stating the details of the audit. The audit team involved from the IRB that will be present at your premises, and it will also indicate what are the specific areas the IRB would want the taxpayer to prepare in terms of questions, as well as a presentation deck to be presented to the IRB as well. So as part of the field audit process, what the IRB would indicate ahead of time is that they expect a presentation by the company's representative explaining about the business operations, your group information, your intercompany transaction, including your pricing policy, and basically your arm's length position. How have you documented this? You need to now explain in the form of a presentation to the IRB. Now, in my experience, what's happened also is more recent audits, the IRB has been doing a lot of their own internal analysis based on the preliminary set of information you provide them. They then send a list of questions as well. With the expectation that this will be covered during the field audit, and the taxpayer must be prepared to answer these questions. So this is quite an interesting approach, where perhaps it's a lot more focused today. They are no longer looking at a broad spectrum of issues, but they are focusing on specific areas with the expectation that these are answered during the field audit itself. Now, the audit itself could happen under different circumstances. One, the officer may decide to pay a visit to the company's premises. So this is the field audit. We note that in our experience during the COVID lockdown process, the IRB was really nimble. They were able to carry out its work online. So there were virtual audits being held as well. So we note that today, the field audits could take a combination of a virtual or actual visit. They may decide to do certain interviews on a virtual basis first, followed by an actual site visit, especially if it's a factory or they want to cite certain assets and order at the taxpayer's premises. And alternatively, the entire audit could happen on site, or as a third option, the entire audit might happen just virtually. Now, this is at the discretion of the officer, which mode he or she decides to take on. Now, during the audit itself, it would entail various aspects. Like I mentioned just now, firstly, they will expect a presentation by the taxpayer. So this would cover all aspects of the business, followed by interviews, not just with the finance and tax folks within your organization, but they may well want to interview your department heads or the operational teams as well. This is then followed by a Q&A session with the finance and tax teams to answer the specific questions that they have outlined up front. Okay? So a typical visit could take any time from 1 to 3 days. We do see that the process is a lot more efficient today. Gone are the days when you have audits for a period of 5 days over a week. The audit nowadays, the visits itself could be a day or two, depending on the complexity of the case again, right? So at the end of the field audit, what the IRB officer would do is they will leave you with a list of additional information required, and the IRB will give you sufficient time to prepare this, and they will review all this additional information offsite. Then we move to the boxes in the center of your slides. So this will be the post-field audit visit. The IRB officer would typically request for any further documents to be furnished within a specific time period. They will then do the additional review, and this accumulates with a findings letter, which will be then issued to the taxpayer. The taxpayer then has the opportunity to respond, to clarify, and to submit any additional information that they feel would support their position. The next stages in the center boxes has to do if there are any adjustments based on the findings. This may involve discussions between the taxpayer and the IRB. This would happen via meetings at the IRB's premises, and this may result in either a case closure or a formal appeal process launched by the taxpayer. Okay? So then that concludes the field audit portion of the process. Now, as I mentioned earlier, typically for the M&C branch, the audit team would review the cases that's already been audited by the field audit team. So there are no on-site visits in this case. In our experience, all the requests are carried out via correspondence, or if there are specific meetings to attend with the IRB. So the desk audit team would usually be quite focused. They will actually look at what are the issues that were raised as part of the field audit previously. They will then focus and understand what is the taxpayer's position in terms of the previous issues that were raised. On top of that, they will look at specific information and carry out certain trend analysis to understand, are there any new areas they need to look at? Then again, for these new areas, they will ask for the additional information. Now, in terms of process, any further discussions that follow suit will be similar to the field audit process, where it follows the boxes in the middle of your screen. Okay? So that concludes sort of an overall view of the current audit process to date. So you would note that in the post-COVID era, the IRB has now shifted its mode when it comes to the field audit. They may choose to either do it on site or virtually. I think in their experience, the virtual audits with the taxpayers have been efficient. They have been able to focus on specific issues, and it does not delay the process in any way. And I think another observation based on our experience, audits today tend to be shorter. They don't tend to linger on for a long period of time. So a lot of the case closures can happen quite quickly as well. Now, let me just touch on the common issues that we see stemming from the audits, particularly the more recent audits. I've segregated the type of issues that we encounter in audits into 4 buckets here. The first one, looking at commercial or business considerations. Number 2, to me, is a very soft target, the intra-group services. So this has to do mainly with your payments for management services. Thirdly, benchmarking issues. And a 4th bucket will be on general compliance. We are seeing how robust your TP documentation is. Now, first, I would start with the business or commercial considerations. So I think typically before any audit commences, once the case is passed on to an officer in the multinational tax branch, they will carry out their own trend analysis. So they are earmarking things like fluctuations to your margins, looking at the losses that have incurred or losses suffered in your business. And they are also assessing, based on the supporting documents that you provided to them, whether in your GL and other information, whether there's been any TP adjustments that have been made either during the year or during the year end. So they will be earmarking these specific areas. They will pose these questions during the audits, trying to understand what is the taxpayer's position, how have these losses or lowered margins come about? Is this due to commercial reasons for these lower than expected margins? Or is this due to your transfer pricing position? Have you changed your position that's resulted in this drop in margins? So this is where they'll be coming from. They will pose these questions with the expectation that you have the necessary supporting documents in place to explain whatever positions you have taken. Okay. So of course, in addition to this, given the recent experience with COVID, we have noticed, and a lot of companies would have been adversely impacted by the effects of interruptions to their business. There have been a slowdown in activity on an overall period during COVID. So with this in mind, that there would be certain adjustments taxpayers would look to make to normalize your margins as well, because these are commercial factors. These are extraordinary factors that were not anticipated when you planned for your financial position in any year. So again, if you are normalizing your margins by making certain adjustments, it is so important to have in place the necessary supporting documents. The IRB is coming in with the view that they are trying to understand, firstly, do these losses belong to you? Should you have incurred this additional cost? Based on your functions performed, the risk assumed, and the assets you've utilized, are these your costs? Should this be your cost? Should this belong to your related party instead? Should you be having these costs in the Malaysian entity? So these questions will all be posed as part of the audit. And on top of that, for the IRB to accept any adjustments where you are looking to normalize your margins, it's so important for you to have the necessary supporting documents in place. Without the supporting documents, the IRB would not even consider your position. They will just look to what your original numbers are, and they will take the position forward from there in terms of any adjustments they choose to make to your numbers. So it's extremely important for you to be nimble in this aspect. You need to ensure that you have all the necessary documents in place to address any questions from the IRB. Now, if you look at the provision of intra-group services, the second bucket, I always call this a soft target because this is a common issue that taxpayers would face in any audit. The IRB is very familiar with this issue. In all the years they've been conducting TP audits, when it comes to management fees, they don't even look at, they will look at your pricing arrangements and your pricing mechanism, no doubt. But in their experience, taxpayers normally fail at the first juncture. So this first juncture is looking at your services. Are you able to demonstrate that the services have been provided and that you have benefited from the provision of the services if you are the recipient of these services? So you're paying for management fees, for instance. Do you have supporting documents to show evidence in these two areas? This is largely unavailable. So as I mentioned earlier on, typical audits involve multiple years. And sometimes it can be very challenging to collate information from years past. Your resources are different, your people could have changed, your systems could have changed. If you're looking for certain supporting documents, you may only have it for the more recent years. Would that be sufficient to pass the test for the IRB? So in this sense, you need to think about what is the best way for you to collate this information from earlier years. There needs to be some form of strategy involved because this is an important area. You need to have a system in place to proactively collate documents when it comes to such issues. Whether this is payment for management fees, there could be also regional charges. We're talking about IT support or technical support fees. All this fall under the bucket of intra-group services. So the most common issue we see and we experience in practice is the lack of supporting documents again. So to show evidence for the services received and the benefits derived. Other typical issues arising from intra-group services would be looking at the appropriateness of the charging mechanism. The IRB may want to understand on an overall basis what is the proportion of charge to the Malaysian entity? What is the markup imposed? What is the benchmarking that has been carried out to impose such a markup? Do you have up-to-date agreements? Do the agreements you have with your intercompany align with the kind of services you're paying for? Again, another issue we see on the ground is that the agreement could be somewhat outdated and would not reflect the kind of services that you're paying for to date. Now, when it comes to the benchmarking set, I think I've mentioned earlier on the timing lag that we have and the mismatch in terms of the data. So the results of the interquartile range or the arm's length range that you choose to follow to meet the contemporaneous requirement could be quite different from when the audit happens. So the audit happens a number of years later. The IRB would have the benefit of hindsight. So there usually needs to be a robust discussion with the IRB about the sample set and data available. So when the audit is picked up and the IRB is looking at the arm's length range, they would have a lot more data available, and therefore they are able to recalculate what the arm's length range for any particular year would look like and carry out their own year-on-year analysis. Now, this data and this range could be quite different from what you have in your TP documents. So again, there has to be a robust discussion with the IRB and some form of negotiation with them so that you can arrive on a compromise position that makes sense for both yourselves and the IRB. Okay? Now, I put the fourth issue as overall compliance. So I think you must remember your TP document is your first line of defense. It's important to have in place comprehensive and complete TP documentation that can stand up to audit scrutiny. The IRB is clear on what's required. They have articulated it in the Malaysian TP rules, both in 2012 and 2023. The TP guidelines serve as providing more details in terms of the documentation requirements. So I'll say that if it's lacking, if your TP document is insufficient in any way, it would be subject to a lot of scrutiny, and the IRB would then it'd be so easy for the IRB to challenge your position that you have taken, and in fact, they will be able to then put forward what they perceive your arm's length position will be. So if you lack TP documentation, if your supporting documents such as your benchmarking studies and your agreements are not there, and they are not reviewed timely and are not aligned with your current practice, you'll be subject to more questions and potential adjustments in an audit. So another point to note on this is that do note that even for companies enjoying incentives, they are not exempt from audit either. They are meant to fulfill the requirements of preparing proper, robust TP documentation. So they are not exempted from any form of audits. And in fact, we do observe in practice that a number of companies enjoying incentives have been audited by the multinational tax branch. Now, to conclude, I think as I've mentioned at the start of my presentation, preparation and planning is key. It is paramount to be well prepared from both a compliance as well as audit perspective to manage your TP risk. Now, the preparation should start from day one. If you are contemplating a new transaction or changes to an existing transaction, you must ensure that you have a consistent policy that you are following throughout and a proper strategy in mind. Now, especially if you are making changes to an existing transaction, you must be mindful that you are looking at a position that you have adopted for a period of time previously. So does that mean that position was not arm's length and therefore you're looking at making changes? So it is important because, again, the statute of limitations is 7 years. The IRB will be assessing your position before and your new position you decide to adopt. So it's extremely important that as you are making changes or looking at new transactions, you must have proper documentation in place to be prepared for an audit as well. You can review your current position when you're preparing your TP document. So when you're preparing your TP document, you could have an assessment of your potential risk areas, for instance. You can identify what could potentially be your risk areas and have a strategy in place to manage difficult questions during an audit. This may mean collating data and documents before an audit. So taking a proactive approach, then you'll be in a better position to explain what position you have adopted and why you consider them arm's length. If you have contemporaneous information and documents that are comprehensive, this will help to support your position better. It's useful to have a TP policy in place. This means that you can take a consistent approach when it comes to managing your overall TP position as well. If there are uncertain positions, you might want to consider taking a proactive approach. If the risk is substantial, do you want to approach the IRB and consider a voluntary disclosure with the IRB? That means the penalties will be lowered. If you have a new position that is risky or uncertain and you prefer for this to be agreed upfront with the IRB, the advanced pricing arrangement route is also available. So to close, I would urge you to consider your current TP position and reflect on the tools that you have and the strategy that you have to manage your TP risk. Being prepared and planning ahead is key to minimizing any potential risks. Now, that closes off my presentation itself. We will then now switch modes to take on any questions that may have been sent in as part of the presentation. So let me just switch modes to see what questions have come up, and then we can address those as well. Okay, so a question coming in respect of documentation. If there are 3 legal entities in Malaysia, or all entities required to have separate TP documents, would one TP document suffice? Now, in essence, yes, you are meant to have TP documents. So the fundamental rule in terms of what's articulated in the rules and guidelines is that you must have TP document in place so long as you have related party transactions. Now, again, having 1 document or 3 documents is a strategy that you need to contemplate what makes sense. If you can have all your information within the 1 document, it covers off all the required sections in terms of the documentation requirements, then that you can actually have 1 document, but it must cover all 3 entities and all the related party transactions and pertinent information. Ideally, I would say it's better to have 3 documents because any audit is entity specific. So it means if you're having 1 document or 3 entities, if the audit is on entity A, you are actually submitting to IRB 1 document with information about 3 entities. So if you're prepared to do so, you can think about the mode of having 1 document. However, I would say it is probably ideal for you to have separate documentation for each of your entities. Secondly, are there any changes to the limited scope thresholds per the TP Rules 23? The TP Rules 23 does not talk about the thresholds. This is actually contained within the Malaysian TP guidelines of 2012. To date, the thresholds have not changed. And so we do follow the revenue threshold of 25 million and the cumulative related party transactions of 15 million as well. Another question around the limited scope requirements. If a company has a gross income of more than 25 million, but your related party transactions is less than 15 million, would the limited scope requirements apply? I'll say yes. It is for the assessment is that you're looking at revenue levels of 25 million plus 15 related party transaction level of 15 million. If you are both measures, then you are supposed to prepare full scope documentation. Below those thresholds, you can opt to prepare limited scope documentation. A couple of other questions coming up. I'm seeing them now. Would you be required to prepare TP documentation by the point of tax filing? If a company decides to file their tax returns earlier, does this mean that I need to have my TP documentation in place earlier? So according to the TP Rules 23, your TP documentation is considered contemporaneous if they are in place by the due date of your tax returns. So the due date, if let's say we go back to my example earlier on of 31st December, your due date is 31st August. So if let's say you choose to file your tax returns by 15 August, you actually still have until 31st August to have your TP documentation in place. And so long as you have it ready and you are dating it before 31st August, it's taken to be contemporaneous as well. Another question I'm getting about timing. So what happens if we get an extension of time on the filing of my tax returns? Now, if your tax returns and you're granted an extension of time by the IRB, the extended time is considered your new due date. So back to my 31st December example, 31st August is your original due date. For some reason, you have then requested to the IRB for an extension of time to 30th September, let's say. That means 30th September becomes your new due date. Your TP documentation will be taken to be contemporaneous if they are ready by 30th September. Are there any instances where Schedule 1 information would not need to be included in the TP document? Like I mentioned in my slides earlier on, one, if you only have Malaysian operations, that means you do not fulfill the definition of the multinational enterprise. Secondly, I talked about thresholds. If you only follow the limited scope thresholds and you fall within that category, for both, you would not need to prepare the group information as part of your local TP document. What are the typical documents? I have a question on audit. What are the typical documents required by the IRB? Now, in terms of typical documents, it's actually quite a standard letter that comes from the IRB. They are asking for quite a long list of information, actually. So firstly, it starts with your supporting documents to your tax return. So that's your tax computation. They will ask for your audited accounts, your chart of accounts, your general ledger, and then TP specific, they'll be asking for your TP documents, your intercompany agreements, your organizational chart, and then information about the benchmarking as well. So if you're undertaking Malaysian benchmarking studies, they will actually be asking for the accounts for these comparable companies as well. Okay, what do I do if it's difficult to obtain supporting documents from my related party when it comes to the provision of management services? So I think, as I mentioned before, it's extremely important to have a plan around this. What would be ideal is if you start collating the documents in the year you're paying for your management fees. So firstly, when you are being charged for your management services, you would know in any given year what you are paying for. So you would be able to appreciate and understand what are the specific services that you're paying for. So beyond the finance team, some of these documents could be sitting with, for instance, your sales team or your IT team or your HR team. So it's important that as the finance or tax person, that you are going to the various teams and asking for sample documents on an annual basis. If you have this and you're able to collate this into a file, you can then be able to collate all this information and have it ready for any audit queries. So as best practice, I would say try to do this at least once a year, have the files together, because it is extremely difficult to get information from 4 or 5 years ago, let alone 7 years ago. So this would be key. Now, if you face this situation in an audit, of course, you've not collated information before, you are trying to start that now. You can try as a strategy to first negotiate with the IRB officer, perhaps looking at collating information for the more recent periods. Perhaps if the sample documents for the recent periods can represent what you have received over the full audit period, is this something acceptable to the IRB officer? So this is something that perhaps as a strategy you can take. Secondly, you may be able to go to the service providers. Usually your service provider, either your head office or your regional head office. They would also be able to at least share with yourselves what are the more recent services that have been rendered and the supporting documents around this. So these are perhaps potentially a couple of avenues you can take in terms of managing this issue. So I think that's all the questions we have on screen, and that's what we see today. So I'll hand it back to Chad, the MC, to close off this session. Thank you for your time today.
Thank you, Ms. Ong Ai-ling, for fielding the Q&A session and for this enlightening presentation on key updates in TP with regards to its new practices and common issues, and highlighting the importance of audit readiness. With that, this webinar comes to a conclusion. Thank you all for joining us today for this incredibly beneficial session. On behalf of the BMCC, we would like to extend our appreciation to Ms. Ong Ai-ling and PwC for collaborating with us to deliver this webinar. Before you go, please provide your feedback via the link in the chat box so we can make our next event better than the last. Thank you all again. Take care and stay safe.